Okay, we have all been in this exact spot. A stock is just on an absolute tear, and you're caught in that classic tug-of-war between the fear of missing out and the fear of buying the absolute top. Well, today we're going to dissect that exact problem, using one of the market's most explosive stocks as our case study. And yeah, we're talking about Vistra Corp. This is a company whose stock price just rocketed from the mid-20s to over $150. That is a more than 500% gain. I mean, that's the kind of move that puts a stock on every single trader's radar. And it leaves every investor asking one really critical question.
So, how does a professional analyst even begin to tackle this? How do they get past all the emotion, all the hype, and build a disciplined, data-driven plan? Well, that's exactly what we're breaking down today, a framework for timing an entry into a red-hot momentum stock.
All right, first things first, let's set the stage. To really understand the opportunity here, and just as importantly, the risk, we need to appreciate the journey of Vistra Corp. That's ticker VST.
For years, Vistra was, it was a stable, maybe even a little sleepy utility company. But in 2024, that all changed. It completely transformed into a momentum darling, becoming one of the most powerful and sought-after names in the entire market. And it was all thanks to some incredibly powerful new tailwinds in the energy sector.
So let's get into the mechanics of it. What was really under the hood of this incredible move? Well, a professional analysis shows that there were two primary engines just firing on all cylinders: momentum and earnings.
Let's start with momentum. Look, professionals don't just glance at a chart and say, yep, it's going up. No, they quantify it with tools just like the momentum cascade. This is a way of measuring a trend's health across different time frames, short, medium, and long term. And this tells you not just if a stock is in an uptrend, but how powerful and how sustainable that trend really is.
And this right here, this illustrates the strategy perfectly. See, the smart money doesn't chase a stock when all three of these momentum signals are screaming higher. That's a huge sign of euphoria, and it means risk is at its peak. No. Instead, they wait. They look for these little moments when the long-term trend is still firmly up, but that short-term momentum pulls back for a breather. This is the classic buy the dip setup inside of a powerful, established uptrend.
But momentum by itself isn't enough. It needs fuel. And boy, did Vistra have fuel. The second major driver was a massive surge in its earnings. In 2024, Vistra's earnings per share, or EPS, it absolutely exploded, growing an incredible 97% year over year.
So the crucial point to get here is that this wasn't just hype. This wasn't some story stock. The stock's meteoric rise was backed by a dramatic, fundamental improvement in the company's actual profitability. This kind of explosive earnings growth is exactly what justifies the market completely reevaluating a company and sending the stock to brand new heights.
Okay, so we've got a fantastic company story, we have powerful momentum, and we have rock-solid earnings. It really sounds like a slam dunk, right? But as any seasoned investor will tell you, the price you pay for that great story is what ultimately determines your success or failure.
And this is where the conflict in our story really begins. After a 500% run, what are the red flags that start popping up on an analyst's radar? What are the cautionary signals telling us to just slow down and think critically before we even consider jumping in? Well, first, just look at the valuation. By late 2025, Vistra's price-to-earnings ratio, its PE, had just ballooned into the 30s, 40s, even 50s. Now, to put that in perspective, the broad market was trading at around 25 times earnings, and Vistra's own sector peers, they were way down at a much more modest 17 to 22 times. Vistra wasn't just a great company anymore, it had become an incredibly expensive one. And valuation wasn't the only warning sign, not by a long shot. Three key things really stood out. First, that extreme PE ratio we just talked about. Second, its Zacks rank had slipped to a neutral hold. Now, this rank tracks what analysts are doing with their earnings estimates, so a downgrade like that means the flow of good news might be starting to dry up. And third, and this one's a big one, insider activity. Over 2 years, corporate insiders sold $250 million worth of stock, while buying almost none. That is a major red flag from the people who know the company best.
So here it is, the dilemma in a nutshell. You have a phenomenal business story that drove the stock up, 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 but now it's trading at a price that seems to have priced in all of that good news, and probably a lot more. The fantastic fundamentals are now clashing head-on with a sky-high valuation and some pretty serious cautionary signals.
So how do we solve this? How do we navigate this conflict between a great company and a really risky price?
Well, a professional doesn't guess, and they definitely don't let FOMO take the wheel. They fall back on a disciplined, data-driven playbook. And the answer, really, is patience. The solution is to just step back from all the noise and wait for a very specific, high-probability entry setup to actually appear. It's all about defining the exact conditions that have to be met before you're willing to put your capital at risk. This is how you take emotion out of the equation.
So, this brings us to the actionable plan itself, a 4-trigger framework. Number 1, you wait for a healthy price correction, a 15 to 30% dip that resets that short-term momentum. Number 2, that correction has to bring the valuation, the PE ratio, back down to a more sensible level. Number 3, you wait for the Zacks rank to upgrade back to a buy or strong buy, which tells you the earnings picture is improving again. And finally, the ultimate confirmation. You want to see insiders step in and start buying the stock again. When these 4 triggers align, the odds shift dramatically back in your favor.
This quote from the analysis, it just perfectly captures the professional mindset. It's not about buying a great company at any price. It's about having the discipline to wait for that moment when a great company becomes available at a great price. That right there is the essence of timing.
So that leaves us with one final thought. In a market that's just full of powerful trends and tempting opportunities, the real battle is often internal. When you see the next Vistra Corp starting to take off, what's going to guide you? Will it be the emotional pull of FOMO, or will it be a disciplined, patient, and data-driven framework? The choice is yours.